Welcome everyone to Mere Finance, where we are going to talk about municipal bonds. Are they the best sub-asset allocation in fixed income for 2023? Let's talk about it. Let's present the analysis and the arguments. That's a big issue with supply this year for all of fixed income, because of course as rates go up, not only companies, municipalities, and governments would like to refinance their debt at a lower rate, but also as their fears of economic growth, companies tend to issue less bonds. So these are the issuance for 2023, for 2022, sorry. So a quarter three, we had 2,088 billion, 2,000 billion. It's almost $2 trillion. And you can see the yellow one, the municipal bond market, which is pretty small if you compare it to the rest of the fixed income market. And that's where it becomes an interesting asset allocation because of the constraining issuance and because of the tax equivalent yields that municipal bonds have in some states that are tax exempt. Then with a lower supply, then value will be increased. So here we're going to talk about how the issuance and the trading was. You can see by sub-asset allocation, and you can also see down there the trading. So you can see municipal bonds quarter to quarter. The second quarter, 16% down, 25% down in issuance for the munis, and in trading, actually 14% up. But an issuance of 25% is significant. It's very significant, and that's where the market was getting ahead of itself. Here we go, municipal bonds. You can see 96 billion as of third quarter in the municipal bonds. Mostly have been issued in revenue in the last quarter. So revenue have been the sector in municipal bonds that has had the most attention. And general obligation are usually the ones that investors have the bigger appetite, because those are the ones that actually are safer, and municipalities can go and raise taxes or try to have a better governance of their own townships, and in order to be able to pay for those bonds. But in revenue, it's all based like a corporation. You try to get a water public system to work or make profit, so it's a little riskier. So those are the profile, and here we can see the U.S. municipality bond issuance by month. See how December just completely went dry, and January hasn't seen that many issuance. So I think when you have a small supply, you can see month over month in 2022, supply trending down, then there is relative value that one has to check. So let's talk about the macro, from a macro standpoint, and then we go into where in the municipal bonds we should go, because we cannot just say, let's just buy the whole municipal bond curve. We have to go and debug it a little bit. So in the macro, this is what Mere Finance thinks. Yields are going down in the short term. You can see this in the capital markets. Market has been shredding in the 3 months to the 1 year, constantly shredding those yields, those rates. Sorry, but we think rates overall are going to be higher for longer. Why do we think that? You can see China is opening up. Copper for us is a leading indicator of inflation. As price of copper goes up, and number two, CPI will go up slightly, and there will be no pivot from the Fed. And also spreads in munis, they will still get up a little higher, especially in the 10 to 20 year rate. These are historical yields that we're going to talk about. You can see the red line, those are treasuries. For almost 2 years, actually 2 years, they were way lower than the municipal AAA 10-year. You can just see the upper bound so low. And now rates just shot up. You can see since July, just like incredibly up. And then the municipals yields just started going down. So these are not equivalent. These are just regular yields. So you can see like there's a misconception in how the market has been developed in the last 2 years until how it started developing since around October. You can see the big changes in spreads. So the yield curve in the municipal bonds is also inverted. So we see that the 10 to the 20 year munis have very attractive yields. You can see here in the left, in the red, 10-year tax equivalent at 40% tax rate is 3.95% versus a treasury 3.45. That's 50 basis points. And in the 20 year, 5.58 versus a treasury 3.75. That's significant. That's almost 186 bips in the spreads, which is significant for that. And you can see here what we're talking about. This is what the policy range is from the Fed Reserve. So the policy range is from 4.75 to 5.25. So the upper bound is 5.25. We can see here what the market is pricing based on the Fed futures. And you can see that, as I was saying, 36 bips were cut down. So the market is like discounting that the Fed might go lower. But actually, if you see, by the end of the year, when you start getting into the summer, in June, July, the market thinks the rates will still go up a little higher. So that's the interesting perspective. And this is where we come to a good analysis that we need to present this graph. So treasuries, you can see here treasuries yield, which is the red one, municipal triple A's, municipal A's, and then the tax equivalent. You can see in the 20 year, so in the fifth row, treasuries at 3.77, while municipals tax equivalent AAA 4.90 and municipal A rating 5.65. So big spread for a pretty good credit rating in a municipal bond. And you can see also in the 10 year, 3.48 for the treasury, 3.73 for a AAA, 4.46 for an A. So very attractive yields. And this is what we see. So you can see in the short term of the curve, the red is the treasuries. Short term of the curve, we don't think there is much value there. Probability value wise, so if you want to get some asset appreciation, it could work because the yields are under the treasury. So any move in the treasury curve could bring more money into the value of the municipal bonds. But we think if you want to preserve a good yield, if you want to preserve wealth, then the place to be is from the 10th year to the 20 year. You can see the big spread there between treasuries and municipal bonds. And I think that's where we have to lock in some good bonds. I think for the next probably 5 years, finally we have that fixed income is finally competing against equities. So, which is the way it should be, right? Like the investors should have in equities an equity premium instead of just taking equities as your risk-free rate, which is what happened lately. So actually, finally, fixed income is showing some lights, and I think this is very attractive to lock some yields from the 10 to the 20 and to preserve their wealth. Here is also the curve comparison between AA muni taxable equivalent yields versus treasury yields. You can see, again, this is across all credit ratings in the upper bound, so AAA, AA, and A's. You can see up until the third year, treasuries have higher yields, but as you start getting into the 10 year, the spreads become higher, and then the yields for those munis become way more attractive. So this is what our view. Let us know in the comments what you think, what you see. We don't think necessarily municipals are like the best sub-asset allocation fixed income, but we do think that in the 10 to the 20 year, the yield is very attractive, and we are long in that sense. So thank you for watching. I hope you have a great week. Let us know what you think about municipal bonds. Are they a play this year? Are they not? Is the supply constraint going to bring more value in municipals? And these yields are really going to be more attractive to investors? Or this is just for now? Thank you for watching. Goodbye.